You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers. Thanks for tuning in. On today's show, we will be hearing expert advice from Joe Mazumdar. He is the editor, analyst, and publisher with Exploration Insights, a very well-respected newsletter. Joe has a lot of experience working in the mining industry, understands the economic side as well as the geological side, and every time I email with Joe, he's somewhere else in the world checking out the projects that he profiles in his newsletter firsthand. Website is explorationinsights.com. I'll also have a link in the show notes. So Joe, thanks for coming back on Mining Stock Education. I'm glad you took the time to speak with me today. And for the first question, I heard two different viewpoints from two people I respect. One articulated that for good projects, there is money there because it's good projects. And then another well-respected person in my mind said, no, for good projects, it's still tough to get money because of the trends of the passive investing via the ETFs, that even some of these good junior miners with good projects can't get money. What are your thoughts here?
Again, thanks for having me. But with respect to projects, I see an issue in, let's say, the single asset developer class, that there's retail money for exploration up to a point. Because in 2019, the amount of financing and the dollars per transaction was low, even though it picked up near the end of May when the gold price was picking up. We've seen lots more financing, but it's almost like, you've been down so long, it looks like up to me sort of thing. But there's a haves and have-nots, but the money hasn't been there, I don't think, as much for the developers. Because the retail industry, I think, is less, retail investors are less interested in that side. They're more interested in the speculative exploration rather than the de-risking mode of development. And then if you take that other theme you were talking about in terms of institutional equity, passive versus active, the reduction of active investment in the mining sector, because the ETF does not actually take part in any private placements, a lot of money from generalists has been flowing more into that than active funds, such that the shrinkage of the active funds have left some of these development plays isolated because there's no money for them. And so to take the next step is more difficult right now in the current environment for a lot of the developers.
But for some commodities like copper and uranium, could it, for a speculator that's focusing on the resource sector, could it be more wise potentially to buy like a next gen at this low price versus an exploration uranium junior? And could the same thing be said for copper right now?
I would say uranium and copper are at two different parts of their individual cycles. Like in terms of a commodity, uranium is low. I mean, it's $25, $26 per pound, but the issue is that there's a significant overhang of inventory. And until I see any kind of long-term contracts being signed at an incentive price that drives people to actually make any money, which is well over $40 per pound, it's hard to say that the uranium market is fixed. If you want to get exposure to a turnaround, I would say something like NextGen is, one of the better developers out there. But as soon as the market turns, what are they going to look for? They're going to look for money. Another option would be something like a yellow cake, where they're buying, pounds of uranium from, I believe, Kazakhstan at about $25 to $26 per pound. And so they'll have a store of uranium for when the market turns. And when the market turns, they wouldn't have to ask for money. They would just sell their uranium. So that might be a better way to play it, potentially, than a next gen. But I can understand, the idea of next gen as well. Another thing that's happening in the uranium market is, the controversy around potentially this current U.S. administration setting up a strategic stockpile of uranium, and there's rumors that they've set aside money to do that, and so that might be a boon for local U.S. producers, which might be a short-term play for some.
And then when it comes to copper, do you have any thoughts to share on the same dynamic in the copper equities?
Yes, I mean, copper is a bit different because it's got a little bit more appeal because of electric vehicles or even hybrids and the additional loading that's required in copper and individual vehicles, which has more of a growth story for copper than uranium right now, and there's less of an overhang right now. I mean, the market right now in copper is balanced, but the problem right now on the supply side is there's a hole with respect to the pipeline going forward, and that's why you will see a lot more exploration for copper by big diversified companies. So there's definitely, if you have a very good copper asset that could move the needle for a producer, there's a good chance that you'll find a strategic partner pretty quick. And you would also potentially find money. So the copper sector is a bit different than the uranium sector, and I much prefer to invest in that one right now than uranium.
We'll be right back after this word from our sponsor. Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. Joe, as you know, we've seen Newmont and Barrick selling off some assets. So my question deals with the combined joint venture they have in Nevada, the Nevada gold mines. If someone is looking at a depressed gold developer in Nevada, the price is a lot less than it has been in previous years, and they're thinking, okay, this could be a good buyout target for the major miners there in Nevada. How far out would a potential buyout, a Newmont or a Barrick, buy a development project in Nevada, considering that they've been selling off a lot of assets and some expect that they could even continue to sell off more?
Well, a lot of what's being sold is outside of Nevada. Like both Barrick and Newmont sold the Kalgoorlie Consolidated Gold Mines, which is KCGM, in Western Australia. They both sold their half of that. Newmont sold the Red Lake asset that they acquired from Goldcorp. But right now, Newmont is saying that they're not in a fire sale and they're not going to be selling anymore right now. They sort of put the brakes on that. Barrick has sold KCGM, but also the Massawa gold deposit in Mali. So right now, I'm not seeing a lot of selling in Nevada because I think it's going to take them a while, and they're doing it now, to realize all those synergies because that's what the market's looking for. And so their big focus is in capitalizing on all those synergies between the facilities, the processing facilities, and the reserves that they build up to generate the biggest win for that combined joint venture. So that's their focus. In terms of acquiring, they don't really, the easy low-hanging fruit for them is within that joint venture rather than outside. So I wouldn't see that joint venture acquiring anything new right now. The problem outside of that joint venture is now a potential company that's got a sulfide asset, which Carlin type, not oxide but sulfide asset. The definition of the Carlin type is the gold is very fine and it lies within what we call Arsenian pyrite, and those deposits are refractory in the sense that you have to have another process like a pre-oxidation circuit to get it out, which is expensive, takes a while to permit. And all the facilities are not owned by Barrick and Newmont. Now you have one less person to talk to. Now you can only talk to the Nevada joint venture, which is run by Barrick. And so you can't play them against each other anymore. You can only play one. So it makes it a bit more difficult for companies outside the joint venture to, I think, potentially get acquired unless they find something significant.
Joe, I read your letter, end of the year letter, and nearly half of your portfolio, you said, was in prospect generators. Do you expect that to change, that percentage to go down as the gold bull market continues to progress?
The thing is about prospect generators, it's all about financing. So if the financing risk is elevated, prospect generation is more appealing, I believe, to the retail market. And when the financing risk is diminished, it's less appealing because the retail market wants 100% of the asset and to own it. I personally, in 2019, have seen, what's happened with financing. And again, it's haves and have-nots. Some people have gotten finance, other people have gotten nothing. So I don't think that the prospect generator model is essentially broken because I think there's still financing risk out there. And the way I think about exploration, I don't think about it as a 6-month to 12-month cycle. It's 5 to 10 years for some of these. So I'm more focused on the management teams in these companies to say that I will continue to hold them because I know that they will actually, construct a good joint venture or find something new. You just need to be patient. And I prefer to own things that I already am comfortable with the management team than the first thing that I'm looking for is trying to dissect the management team and find out how I'm going to get screwed. So I still like the prospect generator model in the sense that, it's going to be funded. There's good people behind it, if you pick the right company, and it's a long-term play. And then the share structure stays relatively tight.
For a pure exploration company, not a prospect generator, would you consider investing in a pure exploration company when they're only going to be putting drills results out once a year because of where their project is located?
Yes, and I have some of those. And so when I see a project that's working on something that I think might get taken out because it is high grade, it's in a good jurisdiction. And by good jurisdictions, I mean by a place that somebody's willing to operate or there's people already operating there. It doesn't have to always be Nevada, let's say. And then say, okay, is the mineralization going to be continuous? Is there a continuity to it? Is there upside potential where they're looking? Have they got an idea of the geological model? Are there good people with relevant experience running the exploration program? So yes, absolutely. With that, yes, I could absolutely put my back behind something like that. But a one-hole wonder, less so. Because then I'm chasing after, do they understand the geology? Did they drill right down the structure? Are they just putting out this hole because they're going to raise money and then drill the same hole over again? So I want to avoid that sort of thing.
I'd like to get your thoughts on some various commodities. If we could start with zinc. Zinc sold off in the last couple of years. What do you think about zinc and any zinc juniors?
Well, I've owned a pair of zinc juniors that I was a bit reluctant to sell, but I wasn't sort of enamored by the zinc market, and so I did sell two. And one was a developer like Tinka Resources that, after I sold, did do a private placement by a strategic, and that was good for them. Because the market really wasn't there for them for another equity raise that they needed. And they really needed some financial backing because they had the scoping study. They probably wanted to move to like a PFS, potentially a pre-feasibility study, but the market really wasn't there for them to fund it. And so by having somebody like Buenaventura in the picture, that helps them a lot. And that's the kind of backing they need. But right now, in this current market, I'm not super keen on investing in a company that's just looking for zinc.
Do you follow the tin market at all?
Not so much, but I've heard, people talking about the tin commodity, and it could be very useful in, in the in the future with more electrification. But I am sort of wary of some markets that are very small. And that's an issue for lithium as well. It's a very small market that you're asking to be very big. Each asset has to be looked at individually. Like, you can get caught up with the leverage idea that anybody that's into tin and, or a few years ago that's into lithium is going to go up. But then you realize that asset by asset, the investment strategy changes from being about leverage or a beta play to more about alpha and specific companies and specific management teams. And that's really where you are with the lithium sector. And eventually that's where you're going to get with tin. So if you're going to look for something in these small sort of industries or sectors like tin or lithium, then you would really have to do a lot of due diligence on the individual company to make sure that they survive through the cycles.
And your thoughts on tin, I would assume, would be applicable to something like graphite as well.
Yeah, and so very small sort of industries. They could go up, they can go down quite easily. And the problem that I have as well is with all the talk of electrifications, EVs and stuff like that, I try to look for commodities that, despite the change in technology, you would still need that commodity. So yes, there's a lot of lithium out there, but lithium will be in all the batteries as far as I can see technologically. So if I can find the right lithium asset that is close to infrastructure, can feed the battery market, yes, that looks good. Nickel seems to be going up in terms of concentration with some of these batteries. So then if I'm looking for nickel, yes, I need that sort of soup to nuts. Okay, they can build it, but is there a battery manufacturer that can take the material with the offtake? And so I'm interested in nickel. Copper makes a lot of sense because no matter what, it's not dependent on the battery technology because all the copper is going to go into the car. And so the extra loading of the car is important. And then in the interim, between electric vehicles coming in 2025 plus, the emission standards have just gotten a lot more strict. So it doesn't matter whether you believe in climate change or whether this is anthropological or not. The issue is that the world is changing and changing their policies to reduce the greenhouse gas emissions. And so if that's the case, how do you lever yourself to that? And lithium, you got to be very specific on the asset, and nickel, copper, and in between, because of hybrid vehicles, palladium. And that's why we've seen, the jump on palladium prices. And palladium was one of the only commodity that beat the S&P 500 in the last decade. And that's because of the loading of palladium, because of the catalytic converters. And most of these are, internal combustion engines.
Are you still bullish on palladium?
Yes. I mean, the thing is that, these engines will still be produced, but, their emission standards will change. So if you still want to drive these, the thing is that you're going to need more palladium to maintain the emission standards. And so automakers are being forced to do that. And then, there's an opportunity potentially for substitution if palladium gets too high. But, there's a cost for substitution that each car manufacturer would have to consider. But right now, I mean, the emission standards are there and potentially getting more strict. And in the intermediate time, the electric vehicles are being produced, but the penetration is going to be, to the point where we might not see, that happening until 2025. But in the intermediate, how do you lever yourself to these stricter emission standards? Well, palladium, as we've seen, over the last year or so, is where it's going. And, they're draining the inventories of palladium, and there's just not a lot of good projects. I would suggest to your listeners, if you want a stock that you just sit on and you believe, in this electric future, a company that's that's very liquid, that is exposed to nickel, copper, and palladium would be Norilsk, with their asset in Russia, and it trades as an ADR in the States. I mean, if you want just to buy one and forget about it, that would be the one.
The Russian jurisdiction doesn't concern you?
I mean, it does with respect to ESG issues, but that stock's done well, and it's a high performance asset. And it pays a dividend, I think about 8 to 10%. So the Russian thing would be problematic, but it's owned by Russians, and it's a very high grade deposit. It is what it is. I mean, I don't put it in the letter just because it's so big that it's almost like owning an ETF or better. So there's not much point, but it's an ETF that pays dividends.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. The company is focused on its Candelaria mine project in Nevada, where there is already a historic resource estimated at 127 million ounces of silver. The Candelaria mine historically was the highest grade silver producer in Nevada, generating over 68 million ounces of silver at an amazing average production rate of over 1,250 grams per ton. The project has tremendous expansion potential as past drilling has outlined deeper, high-grade silver targets for future drill programs. Silver One is highly leveraged to the price of silver and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com. Another metal that's gone up like a rocket is rhodium. What do you make of rhodium, and how would you play that?
Well, it's hard to play rhodium specifically because you really have to play the PGMs, because there's specific deposits that host these PGMs, meaning platinum group metals, and they include platinum, palladium, and rhodium, and several others. But really the ones that have moved the most has been palladium and more so rhodium. Rhodium occurs in the same sort of types of deposits, these big ultramafic layered intrusions like you get in Norilsk or like you get in South Africa. And most of these occur as byproducts to these other deposits. It's harder to find, maybe impossible to find, something that's just rhodium specifically. The way to get exposure to it would be to look at the same PGM deposits that have higher grades of rhodium. And also when you think about it, I mean, this is a key, is that, when you're thinking about something that's not gold or silver, gold and silver are fungible because most companies produce gold and silver, like they produce gold bars. Whereas when you produce a platinum group metal or copper or nickel or any of these other deposits, you produce an intermediate product. You don't produce the final product. So it's really when you have to look at the individual metallurgy of the product that they're trying to sell and see if somebody's going to buy that product, which would be a smelter. You really got to think one step ahead, because if they've got really good grade, great jurisdiction and all this, and then they produce a product where the PGMs or whatever is in, but is not saleable, you're sort of dead in the water because no one's going to buy it. It doesn't matter. So really the retail sector's really got to look at that step, because you're not producing that ultimate fungible product. You're producing an intermediate product. So you got to find out whether that product's actually saleable.
Joe, one more commodity, please, and that would be tungsten. Any thoughts on tungsten?
I'm sorry, you got me there.
Okay, I don't know anything either. Well, then let me try another one. Rare earths.
I mean, yeah, that's an interesting market in the sense that it's one of those potentially like uranium, if they produce a strategic stockpile, or any of these assets right now that people are looking at, like within the States, that are sort of thinking, well, we don't have much exposure to it. We're dependent, on a foreign country. So maybe we should have our own production. And so that would be the interest. But that would be more about playing legislation than playing anything else. And it's hard to predict legislation and how governments change and whether that's still going to happen. So usually I try to avoid over-regulated commodities, that somebody could regulate the profit out of. So I definitely sort of stay away from rare earths.
Joe, as we conclude, based on your interactions with people at the different conferences you've presented at and feedback you get from your own subscribers, what would be some of the most pertinent advice you could give my listeners for 2020?
I would say, first start out thinking about what you want to expose yourself to and have a longer time horizon than just 1 year, depending on where you are. Pick your commodities. Don't pick everything under the sun, but pick the ones that you like, that basically attach to a theme that you're comfortable with. And then when you're looking at the assets, think about the stage. Think about, are they funded to deliver these catalysts? What's going to make the stock go up, over the next 6 to 12 months? And does the management team give you confidence that if the stock actually goes down, you'll buy more rather than having to sell more? So it's a lot of things that it's just a matter of due diligence. But, I like to, in the end, own a portfolio of stocks where I'm pretty confident that none of the companies in it will embarrass me.
You've been listening to Joe Mazumdar, the editor of Exploration Insights. The website is explorationinsights.com, and you can go there. There's educational resources, and if you're looking for specific guidance in investing and navigating the resource sector, Joe has an excellent letter, and you can find more information at explorationinsights.com. As always, Joe, thanks for your time, and thanks for coming on the show today. I appreciate it.
All right. Thank you, Bill.